great future. We're talking real money.
On the road still. Yes, I'm still on the road. Heading to, Chelan, then Seattle. I'm Don McDonald. We're going to talk money and traveling here on Talking Real Money and Traveling, along with Thomas Seacock, the inimitable co-host of this program, sweltering in Seattle. Not sleepless, but sweltering.
Sleeping well, but heated up. Yeah.
A little svelting in Seattle. So we're glad to have you. We hope that if you get an opportunity or you have something that really requires a little financial help, that you call us at 855-935-TALK. That's 855-935-8255. We'll get to where I am. Where's Waldo now across the country with a little red and white striped hat in a minute. But we need to get to the big story of the week. Oops, the stock market stumbled. That happens. It just happens. It's the norm. It's why you get rewarded for owning stocks. It's so important that you get that. So in the last week, the stock market lost, about 2.5%, Tom?
Yeah, about 2.5%. If you look at a global portfolio, on Friday, the S&P 500 tumbled 1.84%. The NASDAQ, down 2.4%. Listen to some of these individual stocks. You want to own individual stocks? You better be ready for a wild ride. Amazon down 9% in one day. Intel 26% in one day.
Oh,
even NVIDIA.
Yeah, that's because they kicked out 15% of their staff.
Got to clean things up. Even NVIDIA lost almost 8% the last 2 days. So the NASDAQ, with that crushing decline, it's now in correction territory. So stand by to be corrected.
Ooh, it's a correction officially.
It is 10%
but
or more.
What does
from
all
its
this
last
stuff
high.
mean? I mean, that's what we really want to talk about on this show is not the numbers, because the numbers really ought not be paid attention to. What we want to talk about is what all of this means. When stocks move up or down, what does all of this day-to-day nonsense mean, Tom?
What it means is nothing in the short term, right? As you correctly pointed out, it's a number. It's not really be paid attention to, because if you do, you end up making bad decisions. And we know over the long haul, stocks kind of head up, generally kind of go up higher and higher and higher, generally. And during those times, even when it goes higher and higher, it goes down, because different things come up. In the most recent case, apparently, nobody knows for sure, because there's 60 million trades or something like that a day. But, we had this unemployment report on Friday that said unemployment's now at 4.3%. And we only created 114,000 new jobs, and we thought we were going to do 185,000. So, this is just horrible.
What a disappointment.
But should it be paid attention to? Absolutely 110% not.
What I find fascinating and a little bit ironic is that everybody, and by everybody I mean all the Wall Street pundits, were sitting around wringing their hands. When is the Fed going to lower interest rates? Well, remember, it's just the overnight rate. It's just the Fed funds rate. This doesn't apply to mortgages or credit cards or any of that stuff directly. But the fact is, they were all saying, well, we're looking forward to it. Stock prices are going to go up. Now you have an unemployment number that is more likely to factor into a Fed decision to lower rates, and yet the market goes down. The market is nonsense day to day. It's emotional day to day. It's silly day to day. And what's even sillier is that after stocks had risen, by the way, over the past 12 months, the Vanguard Total Market Index is up 15%. Over the past 12 months, 15%. So all of you were good with owning stocks during that period. As a matter of fact, you kept calling us and saying, I don't want to own stock. I don't want to own bonds. I just want to own stocks. Well, what's happening with bonds now?
Well, interestingly enough, guess what? Stocks had a tough week, and what had a great week? Oh, that's right. Fixed income or bonds. By the way, the DFIGX, that's Dimensional's intermediate term bond fund of U.S. government securities, now up 3.4%. So what are you doing? Well, according to Bloomberg, You are now moving your money into bond funds, which saw $39 billion inflow in July. So, wow, crazy.
$39 billion and this is by people who keep saying, "Oh, I don't want to own bonds. I hate bonds. Why should I have bonds?" You're supposed to have them all, and then you're supposed to not pay attention. 855, I know you can't help it. 855-935-TALK.
Tom
Call
and
us.
Don are talking real money.
In medicine, a second opinion might save your life. With investing, a second opinion might save your future. The trick is getting one without a high-pressure sales pitch. Well, I'm Don McDonald, and if you've been listening to Talking Real Money, you know that our goal is to help everyone create a brighter future by investing and managing money better. That's why, in addition to helping everyone on our show and podcast, we are also committed to making our 100% fiduciary advisors at Appella available to help everyone make the best financial decisions based on science. So if you're being pitched a financial product or a system, make sure you get a second opinion with no cost, no obligation, and no annoying sales pitch by going to TalkingRealMoney.com or call 800-386-3004. That's 800-386-3004 or TalkingRealMoney.com.
Your guides to a really great financial future. Tom and Don are talking real money.
One of the most important things that we deal with in our lives is money. We all have to, buy things with it once in a while, earn some of it, save it once in a while, we hope, invest it better than we do generally, and try to build a great future. So if you need help doing those things, you should call us, because we're here on Saturdays taking your calls at 855-935-TALK, 855-935-8255. And Grover, welcome to the show.
Well, hey, hello, Don and Tom. I really appreciate your entertaining and educational show. This might be more of a psychological question than particularly financial, but I'm hoping you might be able to point me in a direction. I'm interested, I think, in giving some money away, perhaps on a steady basis, to three separate individuals, each one of them in their 60s. That I know who, from what I can tell, they're living okay, but I think they're just at or above slightly above the poverty line. I don't have any premonitions, but feel that any one of them, could be just one bad event away from catastrophe. I know they don't really have a lot of savings, if any.
No, Tom and I are doing a lot better than you think. We're doing fine. Tom and I are
guilty.
not. Yeah, I know. We sound impoverished, but.
It's very kind of you. Think of us, though. Really.
Yeah. Thanks. No, I'm joking. Go ahead.
All right. Well,
sorry. I want to make that clear. That I was joking. It was a humorous. That was a humorous interlude. All right. So go ahead. You're going to give some money away. Some people who could really use it. Wonderful thought so far.
Yeah. Yeah. I'm 70. I'm single. Recently retired. I live and have lived a very simple life, and even since I've been retired for the last few months, from the way it appears to be going so far, I'm going to continue to live pretty simply and comfortably enough on a pretty modest pension and now Social Security. Two of these folks are already in my will, but again, I just feel like in the possible outcome of me even outliving them, I might be able to help them now better. Maybe even on an ongoing basis.
I don't think that's a bad thing. I think that's a good thing. So.
Well, my question is, are there any strategies, I should say, that you guys are aware of these are proud people, and how do you give money to proud people who may be embarrassed or take maybe even some slight umbrage at being given away some? I've thought about just outright gifts or gift cards or flat out cash or checks, but I don't know and maybe even funding an IRA, but I think these people, none of them have an IRA, I'm sure. And I just think that they could use the money now.
How old are these people?
Maybe I should just wait until they're in their 60s. 60,
okay.
one
all of them are in
all of them. The other 69.
Okay, so the IRA isn't going to make a huge difference to them necessarily.
Right.
The pride thing is the part that bothers
might
me.
Be better or softer. Yeah. I may be wrong on that. I don't know.
Yeah, no, I mean, okay, so let's go back. So, okay, just so we're all on the same page. We think this is great, by the way. And I read a book earlier this year. I'm going to share it with our clients this afternoon called Die with Zero, which suggests that you help people during your life rather than saving all this money and get to the end of your life and then help them. So I think this is absolutely spot on in terms of values and money. So that's great. Number 2, there really is no way to do this and not pay tax on whatever you're going to sell to provide the money. That's another one that people are like, how do I get this? Unless they're charities, there's no way to do it. Then you get to this aspect, as you say, Grover, of, well, I don't want to hurt anybody's feelings. I don't want to, make them feel bad, et cetera. So the only way I've really ever seen that work is as follows. Paying for a specific thing for somebody rather than giving them a handout. I'll give you an example. For example, if they have a medical emergency or they need something that they can't afford, stepping in that way so that you're right at the point of the intersection of the deal and the money rather than just giving them a check, which might make them think, I can't even take care of myself. That could eliminate the pride part of it.
And there's one other thing. There's one other thing that occurs to me. And that is, you said you're already named 2 of them in your will. Well, at least for those that you've already named in your will, there's nothing wrong with telling someone, hey, you're in my will. And what you could do then is say, I put you in my will. You're in my will. You're going to get some of my money when I die. But I've been thinking about this, and I think all of us could probably use the money more now than down the road when you're older too. So I was thinking about maybe gifting you some of that money I'm going to give you when I'm gone. What do you think about that idea? You ask them. So what do you think about that? Now it doesn't feel like charity. It feels like pre-planning.
That's a great idea.
I think it's a very good idea. By the way, I did that with my son, and he suggested a whitewater rafting trip. So I don't know. I mean, we can go on this. It's kind of dangerous.
For you?
Yeah, that's exactly. He's like, let's go on this thing. I don't know. That didn't sound so good to me.
He goes, hey, Dad, why don't we go on a whitewater rafting trip and maybe do some shooting while we're on the river?
And you don't need a life preserver either, dude. You're okay. So, yeah.
Anyway,
that's a very
I think
good
that would be
idea.
the way to. Those are a couple of ways to go.
Yeah, I think you're an awesome guy.
Just be upfront,
Grover.
but be upfront in a way that makes it sound like you're thinking of them. You're really I think enough of you to leave you in my will. But I really thought maybe you could use some. Could you use some now?
Yeah,
if not, I'll leave you in my will. I bet you they're going to say, gosh, some of it would be nice kind of, now. And remember, the 2024 gift tax limit is $18,000.
Which is a ridiculous thing because you actually get to use the lifetime amount anyway. So it's kind of a silly
You're going to use your lifetime
number.
exemption. Yeah, but I just want to throw that in for people who are going to say, but there's a gift tax. Well, yeah, 18,000 is the limit, but you can deduct from your lifetime.
Yeah. It's some
exemption.
I forget the number, but it's big. So,
is that per person or
per person?
18,000?
Per person.
Yeah.
So that's 36,000 for a couple.
Yeah. Don't forget. Yeah, if they're in a relationship, you're set.
Yeah.
It's a silly something. It's something I don't want to say break tax law, but it almost never comes up. Let's put it that way. So.
Right. And I don't know if I'd have enough for that amount anyway on an annual basis per person.
So it's a moot point.
Exactly.
Yeah. Yes. Yeah.
All right, sir. Well, I hope that helped him.
Ideas. I really appreciate it. Yeah, it did.
Grover, we appreciate you being with us.
Show off to a great start. Wow, that's a terrific first call. That really is heartwarming.
I have never. I mean, the whole idea of leaving somebody a big legacy is distasteful to me anyway. It's money you never earned.
Yeah.
It messes up.
It depends
families.
on the parent who leaves it. I think my children feel they've earned it. They've had to deal with me all these years. So.
Yeah, well, I bet you could turn the tables on them and say you didn't earn a penny after what you did to me. What you could do is all you have to do is point to your head and say, you did this to me. You see that hair?
That gray? Yeah. Uh-huh.
Yeah. Do you know it
was blonde.
Gray hair, the cost of gray hair, there's no price. You owe me money.
Priceless.
I don't know how much, but it's a lot. So tell those ingrates. You've taken really good care of your kid.
You've done the same. Stop it.
Better than me. A lot better than me.
Come on.
855-935-TALK is our phone number. But I love the idea, though, of doing... Oh, the dogs are barking.
The idea of the barky. Yeah, good.
I love the idea of leaving your legacy while you can enjoy the other people's fruits of your legacy.
That's why I love Die with Zero.
After you're dead, you don't get to see it. You don't get to see what you did. It's too late then. You're gone. 855-935-TALK. Give us a call, 855-935-8255. I am now in the state of Washington. I have made it to Washington. I'm in the Pacific time zone, just left the mountain yesterday, and heading out to scorching Lake Chelan. Scorching. Oh, it's not 100. Close enough. 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And of that duo, I'm Don. That's Tom over there. We're talking money with you at 855-935-8255. And we started the show out talking about the big decline in the market. It was, this week it was 2.5%. That's so normal, it's almost not worth mentioning, but it did get a lot of media attention. As a matter of fact, you may have heard me yesterday on Northwest News Radio giving
but let's
my
talk about
opinion,
why.
Opining on that.
Yeah, it gets a lot of attention because, number one, it hasn't happened in a long time. Number two, it scares people. People rarely look at. We have a tendency to want to protect our money more than we want to make it, right? So when the market goes down, everybody thinks, and people think, this is the beginning of the promised decline. I got to do something. I got to move my money into bonds, right? No.
Who promised a decline? Now, that's the thing, is that you get some whack job, all over like Market Watch, which
exactly
is and Barron's. Market Watch and Barron's are the most bearish publications.
We should take
those
guys
love to scare people.
The middle of Lake Chelan and drop them off and see if they can make it back to shore. So
1,500 feet deep that lake is. 1,500
even they couldn't paddle
feet.
their way out of that one. That's a ways down there.
Yeah, there's even a myth that there's a sea monster at the bottom.
I think my daughter's still scared because you put that in her mind like 10 years ago and she never got over it.
It was from the 19th century. There were sightings of the Lake Chelan sea monster in the local news. So I am getting ready to leave. Tomorrow I'm heading to Lake Chelan. Tom and I will do a show from there if I don't get melted in my I decided that a big silver metal trailer. What do you put in the oven when you're going to cook something? You put a big silver pan
trailer.
In there.
Yeah, that's
kind of what we live in. But we have the opportunity. We had the opportunity at just north of Spokane to visit with some folks who run a really incredible dairy farm. And I wanted to this is kind of money oriented because they have this family 4-generation dairy farm. They've branched out into selling beef too, which, by the way, just as an aside, I had one of their steaks last night and it was extraordinary. They sell this Angus, what's the cow that makes the milk? I can't remember that. It was on the tip of my tongue, but anyway.
That's okay. Keep going.
My wife is writing me notes during the show.
She is. I see her right over your shoulder.
Yeah, stop it.
The producer.
Jeez. Anyway, these guys, they've really kept up with the times. It's a family-run farm, and they said that we pulled up to the farm yesterday, and the daughter of the guy who started it, she runs it now. She goes, "Oh yeah, the cows all have their own bots," and I'm going, "What? The cows have robots?"
Weird.
Yeah, we went over and toured last night. The cows have robots. Honestly, it's the weirdest, most efficient thing I've ever seen. The cows line up to go into these stalls where a robot milks them, cleans them, milks them, and feeds them some corn and then sends them on their way when they're empty. And the robot knows each cow individually, knows when it was last milked, how much it's eaten, everything about it. And the cows, because it's so fun, they get out and then they go back, get right back in line again. So the robot goes, nope, sorry, you've already taken your turn. You don't have any milk to give me. Go away. and the cow goes away and then comes back through. It is very, very cool. And it has improved the farm's efficiency and improved their profitability, and improved the quality of their product, because it is a very much cleaner, simpler process. You know, have you seen a dairy farm when you were a kid?
Sure. Yeah.
You know,
Got some right down
put
the
all
road from where I live. Yeah.
I mean, they used to milk by hand, and then they got the little milking things that they stuck on the udders. This is no people touch the process.
And so you can say the robots, they control the cows. So you can say that the robots really do help remove utter chaos then.
Yeah, and they're utterly and completely in charge. And I think we should kill the bovine blather, but that's just me. So. Yeah. Well, and that's the other thing, is that we're gonna bring some beef to Lake Chelan from these guys. What's the name of the place? Dairy Lane Farm. Dairy Lane Farm, outside of Spokane.
Yeah.
Elk, Washington. It is a lovely place. They do tours. If you want to see cow robots and you're ever in Spokane, you should contact them. They're on Facebook and everywhere. They do tours and all kinds of cool stuff. 855-935-TALK.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
During the break, I went and looked at the latest online issue of Morningstar. Whereas the Wall Street Journal hardly mentioned the market going down, it sort of mentioned it
barely
obliquely.
Even in there. Yeah.
Yeah. Right. Get this headline. Ready? This is Barron. This is the difference in the editorial team. The stock market is back in panic mode.
Is that what they said? Really? After 2 days?
That is the headline. Wow. This, and then the subheading is, there's an emotional heat behind this sell-off, unlike anything seen in 2024.
No,
they added the 20, so they qualified it with 2020. Yeah. Oh, it's the worst thing that's happened in 2024, which is 7 months old.
Did they mention how much you're making have made in fixed income this year? I mean, come on. Shift it all over there, because the DFIGX, the Dimensional Intermediate Term Government Bond Fund, has made almost 3.5%, 3.4% this year. Wow. And that's
Are we talking about
right?
year to date?
Year to date. I mean, that's been the trade. 39 billion, as I mentioned there briefly, pouring into bond funds. People want bonds, says an ETF strategist. They want the price appreciation part. Now remember,
the price appreciation
is to be believed. Is to be believed. You're going to see a cut in interest rates in September. Short-term rates, yeah. That has to push those fixed income prices up.
Okay, you weren't stating that as a fact, were you?
Well, they're tied at the hip. I mean, so it's going to turn.
No, not at the federal hip. Not at the Fed funds
but
hip.
At the general interest rate hip. So as those yields go down, the price is going to go up. That's what they're saying. And that's why
that's what they're saying. But again, I think is silly, because the fact of the matter is, when the Fed raises or lowers rates, it's only raising or lowering the rate that's charged to banks for overnight funds, immediate money. It does not affect long-term rates. Long-term rates are affected by market expectations. They are affected by the market, by supply and demand, what people are buying and selling, by beliefs, not by it's not a presidential thing. It's not a congressional thing. It's not a Federal Reserve thing. It's an us thing. We move those prices.
That. Yeah, let's talk about that for a minute, because thank you for bringing us into the equation. Us should be worried about how much we need to make on the money and how much volatility we're willing to accept. Us should be worried about when we need the money. Us should not even be considering short-term stock declines, what might happen to the price of bonds, what the future is going to look like after the election, blah, 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 et cetera, right? I mean, those are, and frankly, since you're on the cattle farm, I just want to say that for each of us investors, the stakes are high. Just want to put that in there.
I knew it was going to be. Okay. I knew it was going to be a joke. I knew it. But The steaks are actually, they sell meat individually, which is close to market price. But they'll sell you half a beef or a whole steer.
Can I make a suggestion? Don't bring that to Chelan, okay? That's too much.
Yeah, no. Well, we were going to bring it on the hoof, but I couldn't figure out how. I don't think they run fast enough.
Yeah, okay.
I don't think they run fast enough.
It's not.
But you know what it costs for the beef from a half a steer?
No idea.
$4 a pound. $4 a pound.
Wow. Yeah.
Click, and
sold.
Trust me, there's some steaks in there. You got a big old freezer somewhere?
Mm-hmm. Yeah. I used to do that. I used to have a neighbor that did that, and I bought like half a cow every year from him. It was great.
I mean, these are some. No, it was is it $6 a pound? Did I do it wrong?
You just cut the price by a third. You're a nice guy.
Yeah. Okay, maybe it's $6 a pound. I don't know, but I bought a steak. I bought a steak on the road. I paid $26 a pound.
Wow. Yeah.
For steak. Well, we were traveling to grill up. Oh, and by the way, I told you it was called Dairy Lane Farms. It's spelled Dari
Lane in beautiful Elk, Washington.
Dairy, but not Dairy Dairy, but Dari Lane.
Yeah,
Farms.
That's right.
Anyway, just wanted to make sure I was right about that. And there's a darn fly on my microphone.
I see that. I just noticed it got very close to your nose there for a second.
Oh, yeah, it's driving me. And there's one thing we don't have in Florida. We have never had a housefly in the house. Since we've been in the farming part of the United States, so the western and midwestern. And
guess what?
Houseflies are bloody everywhere. What, did you just smack one?
I did.
855-935-TALK is our phone number, 855-935-8255. We are here to share things that we believe with you, that we strongly believe, better ways to manage money, better ways to earn it, to spend it, to plan for your future financially. But we also answer your questions every Saturday from noon to 2 Pacific, 3 to 5 Eastern at 855-935-TALK. Call right now.
Tom and Don are talking real money.
Do you suffer from hodgepodgeitis? I'm Don McDonald, and hodgepodgeitis is a disease of your investment portfolio whose symptoms include lots of stocks, loads of random loaded mutual funds, and maybe an annuity or two. Most who suffer from hodgepodgeitis dread opening their quarterly portfolio statements. They feel lost and confused. Investing seems overwhelming and the financial future uncertain. If you believe you suffer from hodgepodgeitis, see a 100% fiduciary investment advisor immediately. A proper diagnosis is the first step to creating a portfolio with a purpose based on a personal plan. Start on the road to recovery now by scheduling a free meeting with an Appella advisor at TalkingRealMoney.com. There is no cost, obligation, or high-pressure sales pitch. Take the first step at TalkingRealMoney.com or call 800-386-3004. Hodgepodgeitis is not a real disease, but treating it has been shown to improve mood, reduce fear, and even lead to a brighter financial future. Results may vary.
Your guides to a really great financial future. Tom and Don are talking real money.
We're here all the time talking real money. In addition to the show, we also do a podcast. We've got people from all over the world who ask us questions, which they do at TalkingRealMoney.com. You can call us at 855-935-TALK, though, live on Saturdays. We hope you do. Give us a call, 855-935-8255. But we have a ton of questions that came in through TalkingRealMoney.com, like this one Tom has right in his hand.
Chad writes us from Lansing, Michigan. Do you think the ability to raise so much capital, money, through private equity as a private company is taking away from the small cap premium? Because when or if a company decides to go public, they are in the Russell 1000 and skip being a small cap altogether. Wouldn't that make it hard to find the next Microsoft or Apple before they grew to what they are in a small cap index going forward? What are your thoughts?
It seems to me there's still plenty of small cap stocks out there. I don't think it's affecting the supply of small companies that are coming to market. They may, for some that are popular, well-known private equity vehicles, sure, they may wait a little longer before they come public and become bigger companies and skip past being the little ones, the little micro caps and the like. But the supply overall of stocks has dropped somewhat.
Yeah.
But I would not attribute it to the less than stellar recent performance of small caps. Small caps are like every other cap, large value factors. All of these things are cyclical. They have periods when they do extraordinarily well and other periods when they don't. And I think, again, we're probably trying to overthink it to attribute it to something like private equity. I don't think that's likely.
Well, okay. And to go back, by the way, because you said small caps haven't done well lately. I mean, in July.
Well, lately they have, but
7-day period
I meant for the past several years.
So, yeah, I meant for the
past several years.
Compared to the S&P 500, they've not done as well. No question. But I think what you should take away from this, Chad, is even if that were true, what would you do different? In other words, so what you're saying is I wouldn't invest in small cap stocks because the good ones are already large cap stocks, right? Why would I invest in these ones that have been sort of laggards when I can just put the money into the next Microsoft or the next Apple? And I would argue not to do that. I would still diversify between small and large. I would diversify between growth and value. I would hold all those because, as Don just said, things are cyclical. We don't know what part of the market will do better next. And by the way, it's going to be part of the discussion I have with my clients today, that every once in a while, one of these asset classes kind of comes out of the blue and goes straight up in a way that we did not expect. So that's important.
And the other thing is that private equity is no more accurate at predicting the future of a company. As a matter of fact, might be able to argue they're less accurate. They're just willing to take more risk for the occasional big hits. They don't find all of the great companies initially. They miss out on some. And I mean, for example, Apple had periods when it was hated by both the market and private equity. When it was in deep trouble, they don't always recognize value when they see it because it doesn't always appear valuable in foresight. In hindsight, they always do.
Yeah, it looks remarkable.
By the way, I know what happened.
I think I just read in the Wall Street Journal yesterday that Steve Jobs' widow recently purchased $100 million home somewhere in California. So
I
apparently
think it was the most expensive. I think it was the most expensive house sale in the country.
So no, I would still invest in those things. Do I think this is always, you mentioned the other thing that I do think is reasonable of some greater depth that people really wanted to dive into it. And that is the number of firms that just decide to stay private versus the number of firms that go public to get the cash out. That's a legitimate debate. Again, I wouldn't change how I invested no matter which side of that debate I arrived at.
And the reality is that while something may be the case today, more companies, for example, staying private, that could change instantly. There is an advantage to going public because staying private means you have a very limited supply of potential buyers. And if those buyers' feet turn icy cold, then the only place you have left to turn is the general market. If you really have a value story, or a growth story that you can tell, individual investors often pull back, big investors, where the market can pick up a whole lot more slack than they can.
Or there's times, again, like maybe we're headed into now, where we get a little weak economically, right? I mean, because maybe this week we saw the beginning, maybe not, right? Unemployment's higher, fewer jobs created. Maybe the impact of higher rates finally going to have an impact. That also convinces many people either not to invest in public companies or not to invest in private equity. I mean, this is something you see go up and down.
Right. So it could go all kinds of different ways.
Indeed.
And as Tom stated so succinctly, we get caught up in the minutia trying to say, well, maybe I won't buy small caps anymore because they won't do as well in the future. Or I'm not, value didn't do as well in the past, so I'm not going to buy value. Or another good, international hasn't done very well, so I'm not going to buy international. The fact of the matter is you need all of these things in your portfolio because at any time, without advance notice, you will never get advance notice. They can pick up steam on a dime, and you are going to lose out on those returns. And the other side of that coin is if you're only focused on the segments of the economy or the factors in the investment world that have done well, what happens when they don't do well? Again, no advance notice is going to be given.
They're not going to send you a note. Yeah, and just to, for me, close the book on this whole thing. Remember, looking back I think it's 90 years of data, small cap value stocks have outperformed large growth companies by almost 4% annually. Not every year, not every decade even, but over the long haul, they've made more. And they should. They're riskier firms. They're small. Some days it looks great. Some days they look crummy. So you should have some of your money in those, no matter what your feeling is about the future.
And bear in mind that when you're buying small cap stocks, you're going to buy them all, even though the majority of them, will not do well. It's that minority that does extremely well that makes you the money. The problem, again, is nobody is going to tell you in advance which of those thousands of companies in that small cap fund are going to be the winners 10 or 15 years down the road. And in many cases, longer. That's how you need to wait a long time for these companies to grow into their potential. And
I mean, look at NVIDIA. I mean, that was not a comer for a long time. Then all of a sudden, went straight up.
No, it was a laggard. It just hung around until AI.
And then, boom. Look at those returns.
And then it exploded. And now, because it's exploded, do you think other folks who make computers and chips aren't going to jump on that bandwagon and compete with them like crazy? So, you got the big return if you were in it.
Yep.
Should you buy it now? Well, that's a question. I mean, but if you'd purchased it a long time ago, before you knew, come on, don't lie to me. 10 years ago, you did not know NVIDIA would be this hot. You didn't know it. You bought it, though, as part of a small cap index or whatever it might have been at the time. And then you made a lot of money, which made up for the things you lost money. And that's why we believe you must own the market. 855-935-TALK is our phone number. That's 855-935-8255. More coming up in just a sec.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
And again, our phone number is 855-935-TALK. Call us. Now, there's one more thing we want to cover before we sneak out of here for this hour, and that is some really weird changes that are occurring for your retirement savings in the next year, like catch-up provisions and contributions and required minimum distributions and things like that. What's new for 2025? Some
things are already in effect, but this one is, I think, very not well publicized, and that is if you make more than $145,000 a year, you will no longer be able to do the catch-up provision, which I always forget for you and I. It's how much? I always forget how much. It's substantial in the 401k. In other words, the amount of money you can add on. Is it just
401ks or IRAs too?
just 401ks. The amount of money you can sort of catch up in your 401k after age 50.
The catch-up contribution for 23 and 24 was $7,500.
Okay, so that's $7,500 that today could be put into your pre-tax or traditional 401k. Beginning next year, will have to go into your Roth, so that you can still make the contribution, but you'll have to pay tax on it and put it in a Roth 401k instead of traditional. That's a big change.
So you won't get the tax break.
You will not get the break. You will still get the money, of course. I mean, there's some other ones that are kind of strange. No more RMDs from Roth 401k plans, which, as you pointed out when we discussed this, that really makes sense. Why would they don't make you take the money out of the Roth IRA?
To require you to take money out of a Roth IRA when the government isn't going to get any money out of that is kind of silly. Let it ride.
Let it ride. But here's one. A provision that takes effect this year allows an older spouse who's a beneficiary of an IRA owned by a younger spouse who dies to be treated as if it was he or she were the age of the deceased spouse. In other words, you can use the other person's age.
I got confused through that one.
I know, it's a lot of... you can use the age of the person who died to start taking those RMDs out instead of your own age.
Oh, so you can wait longer.
Yeah, you can wait longer. That's
I should have married...
strange.
Oh, you were smart in the marrying a younger woman thing then.
Yeah. Sure.
You going river rafting?
Quick trip down the Wenatchee River. Some good news for people that mess up on the RMDs. Remember, it used to be 50% penalty if you didn't do them. 50%.
Oh, yeah, it was huge.
Then they took it down to 25, and now they're going to take it down to 10%. So they're really going to be kinder, gentler to you if you mess up and you didn't do the required minimum distribution. And new statute of limitations for missed RMDs. There's a 3-year statute of limitations beginning with the filing of the income tax return for the relevant year, which means the IRS cannot impose a penalty for earlier missed RMDs that are beyond the 3-year limits. In other words, if you want to be a tax cheat, I guess you just don't do them.
If they don't notice,
yeah,
3
years.
Then they can't.
That's weird.
Yeah, they're going to notice. They're going to notice.
You would wonder.
Although they have the most ancient computers, and I've never understood this. The government wants to cut off funding for the IRS. Some people in the government want to cut off funding for the IRS when the IRS brings in the funding that funds the government. It seems illogical.
Yes, it does. And then here's perhaps a good news for people that are in SEP IRAs and simple IRAs. You can now put Roth contributions in those, whereas it was always pre-tax or traditional ones. You can do the Roth there too, which just makes, again, sense. Really?
Yeah, I mean, you've been able to do it for everything else. Well, if you want more information on how you should manage your money, how you should build portfolios, you want to ask us questions, you want to listen to the podcast, you want to ask one of our advisors something, we'll meet with you for free. Just go to talkingrealmoney.com.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.